Hello, welcome to another Daily Dose of Insights powered by Container xChange. My name is Christian, and every other day we bring to you the key news, stories, and data points that move container markets and hence your business. Today it's Friday, so we typically have what we call Fundamentals Friday here at xChange, where we pick one key topic a little bit as food for thought for the weekend and share some perspective on that. Let me quickly share my screen to give you a little bit more guidance of what I'm talking about here. Just a second. Here we go. So today, very interesting data released by Drewry actually late last night about the World Container Index, both on the composite side, so that's the left-hand graph, as well as the Shanghai-specific graph, so trade routes from Shanghai into key European locations, so Rotterdam and Genoa in this case, and key US locations, Los Angeles on the West Coast and New York on the East Coast. And what you see is the graph, or the kind of graph that we've seen over the past weeks. Increasingly, we've seen that spike after the start of the attacks by the Houthis in the Red Sea. This is the first sort of plateau here at beginning of this year. Then a little bit of an easing in the market, also fueled by hopes that the geopolitical situation might ease up more quickly than anticipated. And then another spike here up to July this year, really fueled by a pull forward of orders, specifically on the retail side, which fueled demand for ocean shipping capacity without a real strong fundamental underlying consumer demand growth. And what we see now is sort of an easing of rates over the past couple of days or 2-3 weeks since that high. And that's really true across all key trade lanes from Shanghai. The European locations seem to be a little bit more stable here than the US destinations, but that might also be a little bit of a timing issue. We believe that the rates will soften going forward just because there's still more and more capacity coming online, and we really don't see this demand rush being carried further into the end of the year, just because we believe this is more a pull forward of orders than a fundamental strong demand. At the same time, also if you look at stock markets, the scare that we had at the beginning of the week with sort of worse labor market data from the US indicating a potential softening of the economy has abated a little bit as well. So the market seems to be a little bit more confident that there will still be a soft landing, that the Fed has not been too conservative in its rate policy and not too late in its rate policy, but how that will play out, we'll see over the next couple of weeks, I guess. Now, lastly, we've just released our container market forecast. I'll paste the link also in the comments. I think very, very interesting there. We look at sentiment of container traders, both in the US as well as in China, and we look at the differences. So stay tuned for that. I think that's very, very interesting because the market, from a sentiment perspective, still expects prices to increase. Now, that's it from us for today. Thanks a lot for tuning in. Have a fantastic start into the weekend, and yeah, see you all on Monday. Take care.